Today I'm highlighting another example from the book that I'm reading by Douglas Andrew called The Misfortune to Dispel the Money Myth Conceptions. Isn't it time you became wealthy? And the point of the conversation, or the example, is kind of a follow-up of the recent ones I've been doing, talking about, is postponing tax really a good idea, or really the best idea, I think is what he says. So today, instead of reading from the book, I pulled out a couple of pages. He had an example that I think you should be able to see my screen by now, but he has an example that he uses that I will say up front, the numbers aren't really realistic, but hopefully conceptually the example is helpful. All right, so before we get into the numerical examples, did you know that taxable income in retirement may cause you to pay taxes on your Social Security income? If you are single and your taxable income in retirement is over $34,000 per year, up to 85% of your Social Security tax may be taxable again. And I say again because you pay taxes on your income before you contribute to Social Security. So if the IRS is going to tax your Social Security after they've already given it to you, you are actually paying taxes twice. So it's a double tax. And unfortunately, most people aren't aware of that, which I think is unfair, and we should all be aware of how we're going to be taxed, whether that's now or in the future. If you are married and your taxable income in retirement is over $44,000 per year, up to 85% of your Social Security may be taxable again. So the reading between the lines, that means the IRS says that if you are single and make more than $34,000, or if you're married and have more than $44,000 taxable income, you have more than you need, which I don't know how many people actually would think that $44,000 a year, if married, is a lot to retire off of. So continuing on, did you know that Medicare Part B and D costs are determined by your taxable income in retirement? So the more you make, the more you may have to pay. Did you also know that Congress is trying to pass the Secure Act, which would likely increase the amount of your taxes your heirs would have to pay if you leave them tax-deferred money, which I think is ironic because they're also making it easier for you to contribute to tax-deferred accounts. If you're interested in learning more about that, I talked a lot about it yesterday in my conversation, so please check that out. Like I said, this example is provided by Douglas Andrew. I can't say I agree with the numbers and the assumptions he used, but I think the example hopefully conceptually will provide you value along with the questions that are posed. So he assumes that if you're contributing $4,000 per year for 30 years, that's $120,000 of total contributions. And he's assuming a 34% tax bracket. All right, so as we know, your top marginal tax bracket doesn't actually affect all of your income. It's just the top, so your effective income is actually more important, but we'll go along with the example. All right, so if you're tax saving each year, if you're contributing $4,000 per year at a 34% tax bracket, you're going to save about $1,360 of tax savings each year for 30 years. That's a total tax savings of about $40,800. So if $4,000 saved per year growing at an assumed 10% rate of return, which is probably high, each year for 30 years, your account will grow to about $723,774. If we assume you continue to get 10% rate of return each year in retirement, you could theoretically distribute $72,000 per year of taxable income from the interest without affecting your principal of $723,774 within the account. $72,000 taxed at 34% would be $24,480 owed to the IRS, which would leave you $47,520 of net income per year to live off of, plus your Social Security, which would likely be taxed, and any other savings that you have. In this example, it will only take you 20 months for you to pay back the $40,800 that you saved while you were working to the IRS while you're in retirement. So what he's saying is it really worth saving that $1,360 per year for 30 years to only pay it back in 20 months once you're in retirement, and then pay back more than that as you go on working, as you go on living in retirement, depending on how long you live. All right, so note, a 10% withdrawal rate only has about an 80% chance of lasting 10 years in retirement and an 8% chance of lasting 20 years in retirement, according to Vanguard's retirement nest egg calculator. So we likely would not and should not use a 10% withdrawal rate to plan for retirement today. Additionally, assuming a 10% rate of return each year is likely too high as well. So this example is used for conceptual purposes only. I want to make sure I repeated that because I do not want anyone out there to assume 10% rate of return each year is realistic, and definitely not 10% withdrawal in retirement, because that's extremely risky if you're planning on living for more than 10 years in retirement. So last but not least, I wanted to ask the question, did you know, or actually Douglas asked the question, but I want to highlight it. Did you know there's a means by which you can draw your retirement income tax-free to avoid these penalties for successfully saving for retirement? In other words, did you know it is possible for you to plan for retirement and completely have your money off the radar screen of the IRS so that all of your income is after tax and doesn't affect your Social Security, doesn't affect your Medicare costs, and won't leave your heirs in a bind if you pass money on to them? Because basically the way that the system is currently set up is you are penalized for successfully planning for your retirement because due to all these added taxes or costs. All right, so hopefully this conversation brought you value. Please let me know what you think by reaching out or leaving a comment. If you like the video, please click like, or even better yet, share it with a friend. Obviously, if you're listening to this as a podcast, I don't think there's a like feature, so just share it with a friend and I would greatly appreciate it. Thanks again for taking the time to listen or watch this video. I hope it brought you value, and I hope you have a great rest of your day. Thanks. Bye.